Our session moderator, we have with us Sajith Mangat, Senior Executive Editor, ET Now, who will be spearheading the session. And while we have Sajith to spearhead the session, let me also quickly invite our panelists as well. We have with us Pushkar Johari, Managing Director and Head, Private Equity, Value Quest Investment Advisors. And we are also joined by Ramakrishnan Kalyan Raman, who's the Senior Managing Director, Strategic Relationships, Spark Capital. So let me invite all our three speakers right up on stage. It's going to be an investor focus, so let the session begin. And Sajith, over to you.
Thank you very much. Pushkar, we are now a $4.3 trillion economy, and we want to aspire to become a $10 trillion economy. And as you are a private equity player, if I were to ask you, there are sectors that propel us to 4.3 trillion. Which are the sectors that will propel us to 10 trillion economy?
It's a very good question, and thank you for having me here. It's one of the questions we grapple with a lot in private equity. Where do we deploy capital? Where do we see growth happening which outpaces the economy? So what we have done at ValueQuest, and as a fund manager, what I have done is I've looked at a range of sectors where I believe India is at an inflection point and where we are likely to see high growth in the coming years. One of the sectors is aerospace. We clearly think that you have to play to your strengths as an economy, and our strength is economies of scope rather than economies of scale, and that is where low volume, high precision work has been India's strength. So aerospace is clearly one of the sectors I am very positive about. Another area I am very positive about is energy transition. I think our next 20 years are going to be a lot more energy intensive if we are going to be a more manufacturing driven economy. What that means is we cannot keep on relying on fossil fuels. It's no secret we import 85% of our petroleum. So if we are going to be more energy demanding as an economy, we need to generate our own energy. And the game in town is solar today. There may be other sources like nuclear. Some of the other sources may come up. So we are very bullish on energy transition theme, where newer sources of renewable energy will come up, and that will also propel us forward.
Ramki? He spoke about aerospace. He spoke about...
I largely agree with what Pushkar said. So if you look at the breakup of the GDP today, it's about 60% from services, about 22% from industrials, which includes manufacturing and construction, and the balance 16-17% from agriculture, right? So that's largely good. The agri part is largely going to remain the same in my view, unless we step up on agri exports, which I think, given all the trade pacts that we are doing, I see a scope for stepping up significantly on processed food and agri exports. I would add to that list auto components. I would add to that list electronic manufacturing, which have been thrust areas. I would also add to that list digital services, the whole orange economy that was spoken of in the budget. I think there is tremendous potential there if we package it and send it out. So to me, in addition to what Pushkar said, these 3 or 4 things will potentially drive it. We need to step up for the sake of the country and for the sake of providing employment. We need to move the manufacturing from 15-16% into the early 20s kind of levels, and that is going to be a propelling effect. In course of time, I think from being import substitution, we need to move to a stage where we are strategically resilient, and eventually to a stage where we are strategically indispensable. And the difference between resilience and indispensability in my mind is, resilience is, can we carry on with our life when the world breaks down? And indispensability is, will the world break down when we stop, right? So I think we need to look at moving along that curve. And if we move along that curve, a bunch of these sectors that we spoke of will be the anchor sectors on which the economy will thrive and grow.
We were on the receiving end of supply chain a few years back after COVID. Do you think supply chain is going to be the focus for the next maybe couple of years or a decade, and we will be exporters from like what Ramki spoke about, agri-processing, or for that matter, any other sector where we are going to, and you mentioned about electronics and others, we will be more focused on that and making supply, becoming a very, very big player in the global supply chain as a whole.
I think India has already been part of a global supply chain, but in our own, let's say in the last 20 years, it's been on the services side, on IT technology services, and also for pharmaceuticals. For example, 60% of vaccines globally are made in India. You cannot be such a critical component of global supply chain without having chemistry skills, without having the kind of capability we have built. I think there's a lot of room in India for taking the game forward into newer sectors as well. Ramki mentioned EMS, electronic manufacturing. I think that's a great example. I'd just like to maybe reflect back on China's example. You look at, I was reading up in 2007 was maybe 19 years ago was the first time iPhone was manufactured in China. Guess what was the value add from China out of the total bill of materials? It was less than 5%. Out of $200, $250 bill of material, they were making $6 to $8 of value add in China itself. Rest of it was all imported because the ecosystem was not there. What they did very smartly over the next several years is that they kept backward integrating. And that is where today you are probably seeing 45-50% of the bill of materials being made in China. So that's the kind of, we have to be in some sectors like EMS, we have to be prepared to take the long game, play the long game, and identify core areas where we can really win over a long period of time. And at the same time, there are newer areas, for example, aerospace as an example. Today, I was at speaking to one of the two global OEMs. There are only two guys who make manufacture aircraft, civilian aircraft, Boeing and Airbus, which was one of them. And he told me that we outsource only 1% out of India. And the plan is to take it to 10% over the next 10, 15 years. So you're talking about a 10x growth in that sector if we get our act together. And we have the skills and the capability. We have always had the talent. It's just that talent hasn't found home in the form of a homegrown enterprise, which has led to revenues and business in India. It's been talent which has worked for multinational companies and in various organizations. But we are beginning to see some of that in private equity. We are beginning to see a lot of new emerging aerospace models come up, which are going to play a huge part of it. Space, for example, we had a speaker earlier in our discussions where people were talking about the space problem. There are 150,000 spacecrafts. Now, there are things you can do in space which are developing newer forms of drugs, etc., where I think India is going to play a role because we have a lot more cost-effective way of reaching space, developing the payloads, the LEO satellites, low Earth orbit satellites. So there are areas which are driven by science, technology, low volume, high scope, high differentiation. Those are the areas where I think we will integrate a lot better and contribute, and that is what will drive our exports.
Ramki, how do you see that? South India has been the main hub for STEM education, which is there, and that's where you're seeing a maximum number of startups in the aerospace or the space coming up. Do you see the South India now emerging as a hub for not only startup but for these specialized verticals going forward?
South India contributes roughly about 30% of India's GDP, right? The four southern states together. And they have had a very healthy mix of both manufacturing and services, right? So if you see India's growth, it is going to be, if I were to put a matrix, it is going to be domestic and export, manufacturing, services, and agriculture, right? So that's a, let's say for simplicity, let's break it out into two by three matrix, right? We are fortunate that we have a fairly large domestic market at about 820 billion counting. Exports makes about 4% of India's GDP. So it's not significant, right? Now the idea is to, and most of the, if you see the Asian tigers, most of them have significantly grown thanks to their lower population by export growth, right? So I would take a bet that given the disintegration of supply chains and given these nearshoring that is happening, and it is no longer about just in time. I think it is about just in case, particularly after COVID and after what is happening with the United States. I think people are preparing for the rainy day. People are making sure that in that eventuality they will have a supply there. So I think India as a very, very key integral player in the supply chain is going to emerge, number one. Number two, South India will continue to dominate or play a very pivotal role in addition to developed states like, let's say, Maharashtra, Gujarat, and Tamil Nadu, Telangana, Karnataka in the south in particular. The mix is going to be largely driven by manufacturing because Chennai is already, and I can't sit in a forum and not talk about Chennai, coming from there. It's already the Detroit of South India. We make 40% of India's electronic exports go out of Tamil Nadu. So I think we are there. We employ 43% of the women workforce in the factories in Tamil Nadu. So every little ingredient that you consider is there. So I would continue to think South India will play a pivotal role. But I think in the larger interest, it is important to lift the states which have not seen active economic growth in the past, slowly but steadily, and make them match with the rest of the country. Because otherwise we will have an issue of internal migration, which is already happening there. Right? For example, the population of a state like Tamil Nadu will decrease if we don't have immigration from other states, because the fertility rate is below the replacement rate. So these are realities of this country, right? And for us to paint with one broad brush for the country at large may not really work. We need to look at each of these micro markets or states and then try and see what will work in each of these states. But the short answer to your question, yes, it will continue to play a role. I see 30% probably going to 33, 34% or 35%, because some of the other states will also naturally grow.
Can I just add something?
Yeah,
to it?
please.
I think you are underestimating South India's potential. I have four portfolio companies which are in technology. 3 of them are in South India. So.
Pushkar, if you look at the $10 trillion target that we have, capital formation will be a big part of that. And for that, capital markets will be a big player there. Do you see many more South Indian companies now coming to capital markets? And South Indian companies have been very shy with respect to their homegrown businesses. They don't come to capital markets very often. But do you think that is changing now? More South-based companies are now coming to capital markets to raise capital. Of course, from a PE point of view, you guys are also helping them because you also need exits. But
so my experience is very different. Like I am probably dealing with the younger generation companies. They don't think they are from South India. They just are located in South. They are thinking India overall. They are thinking themselves as product companies and making the products and services for India and global markets. They happen to be domiciled in South India. They happen to be just born there, lived their lives there, but the next generation is not thinking parochially. They are just thinking very differently. That's been my experience of dealing with them.
Ramki?
We raised about 1.95 lakh crores from the Indian capital markets last year, right? 60 odd billion, 56 to 60 billion was the private equity flow. I have been through a career where I have seen Indian companies gingerly tap the global markets for capital, right? And it is extremely gratifying to see a Hyundai, a Orkla, a LG come and tap the Indian capital markets and list their Indian subsidiaries. Right? So people came to India for the market, people came to India for the labor, now people are coming to India for the capital. Perhaps because we give the valuation which is probably not there in their geographies, right? So I think the depth of the market has dramatically increased, and that is going to only deepen further, right? We obviously need to deepen the bond markets we've been talking about for 30 odd years. I think the time has come with all the technology happening around us, that will happen in course of time. So capital is a key ingredient, and today I would say that, look, if you have the right business model, the right expectation around a deal construct, capital cannot be a constraint for your business. The days are gone when India is capital starved. The days are gone where entrepreneurs can come back and say, look, I don't have capital to grow, right? If you have the right business, if your expectation of valuation is right, and if you have demonstrated the ability to scale a business, there are enough people like Pushkar who are there with, their purse strings open, right? Will they write a check behind everything? Perhaps no, right? But so capital, I don't think is going to constrain. We just need to temper down our expectation. I think over the last decade and more so particularly after COVID, we have had a secular run in returns, and that has kind of pivoted the expectation of an average investor into a different zone. Is that going to continue? Perhaps not. We need to be a little more calibrated about it, and we need to be a little more patient about getting those returns. So if we blend a moderation in our return expectation with some degree of patience in our outlook, I don't think capital is going to constrain our growth. There is enough capital. I think the fisc is under control. In spite of, the government spending 14 lakh odd crores of capital expenditure last year, budgeting for about 17 lakh crores this year, but still we are on track, right? We have achieved the fiscal targets. So to me, capital is not going to be a constraint in achieving this. I think we just need to be very, very positive about it. We need to have the conviction that we can actually get there. And in the process, compromise some short-term expectations for longer-term, success and longer-term outlook. That, I think, is a larger mindset that needs to change among people at large and in the minds of investors at large. That's the way I would put it.
How do you see traditional businesses adapting to this change? Pushkar spoke about the fact that the new age, young generations companies are, because they are based out of South, that's why they are very savvy to capital markets.
Break it geographically. I think there is a generational shift happening across across India Inc. Right? There are legacy industrial houses of the independence era, and there are industrial houses and industrial groups which came into existence in 1991 during the liberalization, right? The 1991 guys are a little over 30 years old, right? So you're clearly seeing a generational shift. The current generation which is coming there with a completely different outlook, right? A large part of my time during my day job is spent trying to moderate the transition between the patriarch and the next generation, right? Their outlook towards...
Is it easy?
It is not easy. It's a struggle. You get paid for it, so you go through the struggle. So, but yes, their outlook towards businesses, their outlook towards dilution, their outlook towards taking external capital, towards tapping the market, is completely different from the way the previous generation looked at it. So I think they'll be a lot more open-minded because they've seen the world, and they also know that, look, if we don't do it over the next 15, 20 years, when every factor is, kind of confluencing and coming to our advantage, we are probably never going to do it, right? And I think that is a realization that is there in the minds of most people, and more so in the minds of the younger people, right? The 30s and the 40-year-olds who probably have 15, 20 years of work ahead of them. They realize that, look, this is going to be, as to use the cliched word, the Asian century, and more so within the Asian century, the Indian decade, right? So I think we are all beginning to believe in it, right? It may sound very cliched, we may be repeating it, but I think there is an element of belief in all our minds, right? That is there even in the minds of the corporate sector. That is there in the minds of the political leadership. There's in the minds of the bureaucratic structure of this country. So all of these, if they work in tandem, I don't see a challenge in getting there, and I don't see capital being a constraint. We just need to recalibrate a few things.
So, capital is not a constraint, but risk-taking ability. Do you think this generation has a much higher risk-taking ability as compared to the older generation?
You bet. See, the level of confidence and the risk-taking ability is phenomenally different. I'll tell you what, let's say, if I reflect back on my 15 years doing private capital, 2000, I think 7, 8, 9, we used to fund a lot of first-time capital takers, and we were doing mid-market PE. Mid-market for parlance, general people is companies with, let's say, 150, 200 crore top line. Yeah. Today, by the time these companies come to us, they've grown much faster in their journey. They have taken capital much earlier in their journey. And by the time we are funding them, they've already done 2 rounds of investments. So that mindset shift has happened, that people don't want to just develop products and develop the product into a business over a 10-year journey. They want to develop it in 3 years, 4 years, 5 years. And that requires a certain risk-taking ability. What has also changed is a lot more professionalization and institutionalization of private capital. See, in 1999, Chris Capital came in. They started earlier as a venture. Chris Capital is one of the well-known Indian private equity firms. So their journey has been amazing. Over now they're into 9th or 10th fund. Latest fund is $2 billion. Today, you have institutionalized capital available from angel funds. You have early stage venture funds. You have venture growth. You have private equity. You have mid-market private equity. You have late stage. So there is capital available in with very different risk appetite.
You're forgetting family offices as well.
And family offices, yeah. I'm just talking about institutional capital, but yeah, family offices is the new. A lot of founders have taken call to monetize their businesses, and they have sold it to somebody else, and they're sitting on a ton of wealth, and they have their own family offices. Sometimes people have done part stake sales, created a family office pool to invest in new companies. There's a lot of capital today. Today, capital is not a constraint. It's the quality of the idea, the business model, your go-to-market strategy, your product market fit, your ability to have high conviction and ability to build a professional team that will run with you. Those are the things that drive your ability to raise capital. It's not the quantum of capital that's out there.
And your expectation of valuation.
Absolutely.
And how
there you have to help Ramki.
And how's that doing in the current scenario, Ramki? Expectation of valuation?
I mean, that's like the season, right? You have winter, spring, summer, and you have the rains. So depending on what it is, you swing between funding summer to funding winter, and it's a state of mind. But if if an entrepreneur needs capital to build a business, he will take that capital, right?
Even at the risk of losing control.
Control is a state of mind, right? Control is a state of mind.
When we talk control, basically below 51% taking this.
I think people are a lot open about it, because if they see that there is going to be more economic value in the residual stake, that obsession to have control is no longer there, right? At least in large number of corporates. I should not be generalizing it, but in the large part, I think this control phobia is gone off. And people are okay about taking capital as long as they say economic value creation. And today capital is available. So obviously they will embrace that, and they will make sure that they put it to work. And if you have a decent ROC business that is going to generate over a period of time and compound at rates which are significantly higher than the underlying economy, then you're going to create value for yourself.
Pushkar, do you get this question about control when you're investing in companies? Because many of the new age promoters hardly have any stake left by the time they come to public markets.
So, because people are trying to build businesses and progress the journey much faster, founders have become more comfortable going below 51%. But I'll say that there's a fine balance. You don't want to hit the IPO market where promoter stake is 10% or 15%, because then the question is, who's the founder? That's also something which, at least on the listed side, our investors want to see some credible level of promoter stake as well. So there's a fine balance there, but I think people have gotten over the mindset of being 51% or higher. I'm seeing so many founders, like most of my founders, actually the young companies, the new age companies have founder stakes below 51%. It's more institutionally owned. So there's a framework of taking the right decisions for the business in a very collaborative effort, but the decision still sits with the founder. But he is open to taking good advice from a lot of good investors.
Pushkar and Ramki, thank you very much for joining us. Thank you.
Thank you very much, and we'll capture that in the form of a